My guest is Todd, Co-Chief Investment Officer at Greenwood Capital. Walter, let's talk a little bit about some of the technology stocks. We'll get to energy in a second. Technology, like Hewlett-Packard, they're making their run on 3Com. That deal's going to close, I guess, in the first half of this year. And then you also take a look at IBM. Why these technology names?
Well, you look at these names. First of all, they did very well in 2009. So 50% or so. But if you look at the valuation of these names, I mean, you really focus in on IBM as an example. They're going to earn $11 in 2010. I pretty much guarantee that. And this trading at 12 times. So we think you put a market multiple on that name, you're at $150, $160 a share versus the 129 or so that it closed today. So we think it's not a stretch in terms of a valuation standpoint. They're paying a good dividend. They're probably going to raise that 15 to 20% again this year. So just looking at both the fundamentals and the valuation is a very good combination for both of those names. And you look at a lot of the large cap stocks in technology, you see a similar scenario. Look at Intel, Microsoft, et cetera.
Right, but when you put the market multiple on it using that kind of scenario, what happens if your larger asset allocation picture comes to fruition where you say, all right, you're going to take some money off the table, you're going to go into healthcare, you're going to go into some of the sort of contrary bets, things that did not do well, because you're concerned that maybe the market's going to face a little tough sledding.
Yeah, and but if you do see that pullback, I think these names versus some of their smaller peers are going to be a safer place to be. Certainly not immune from downside, but should hold up much better in that type of scenario. So it's kind of a barbell approach that you're taking. You're putting some defensive bets on, but at the same time you want to have some cyclicality in the portfolio if the market continues to run.
All right, so you got IBM and Hewlett-Packard in technology. Tell me about in healthcare and pharmaceuticals. You like Abbott?
Abbott, same scenario really. You look at 10 to 12% earnings growth, trading at 12 to 13 times, pays over 3% dividend yield. Again, very well positioned, actually diversified. It's in the pharmaceutical space, but it has devices, it has nutritional business as well. So like a Johnson & Johnson is more of a diversified pharmaceutical company.
You also like Walmart here.
Yeah, Walmart's controversial. You know, it did great, relatively speaking, in 2008. Definitely lagged last year. But we think the money's going to circle back to this name. If you look at where it's trading 10 years ago and where it's trading today, it's virtually the same, yet earnings, you know, are a multiple of what they were in 1999. So it's very cheap. Probably going to continue to raise their dividend. And a lot of people underappreciate their international business, which we think is
big
upside.
Operations in Mexico, for example.
Yes, and Europe and China. So again, we think we like the international exposure and the valuation there as well. Talking
about international exposure, you also like McDonald's.
McDonald's, again, you see a theme developing here. Right. Large cap, international, global operators. McDonald's certainly fits that bill. They just raised their dividend. They're paying a 3.5% dividend yield, 10% earnings growth, trading at 12 to 13 times. Again, if you start to put market multiples, I would argue they should trade at a premium, quite honestly, given the stability of their earnings. But just a market multiple would give you nice upside to all these names we're talking about.
All right, what about upside in the financials? I know you own Bank of America. You've got some shares there, but also you're calling for Morgan Stanley. You like the shares of
Morgan Stanley, I think, is well positioned, like their peer. I don't use the plural there. It's just their peer, Goldman Sachs. So Morgan Stanley and Goldman Sachs pretty much have a run of the place. Although I'm sure Jamie Dimon would debate me on that. But they're well positioned in terms of the capital markets, and we think M&A is starting to pick up. Really started to pick up late last year. We think that's going to continue. IPO market picking up.
So you like that yield curve? The slope is very favorable for financials.
On the banks and financials, it's a very the steepest yield curve we've had in almost a century, and so that'll flatten, but it still should be good.
What about Emerson Electric? I know this is one of the companies you're following. Industrial company, global industrial.
Global industrial company. Emerson we have owned probably for 15 or 20 years in our portfolios. It's just a great, solid name, good management team.
Hit a new 52-week high today, paying about a 3% dividend.
Exactly. So it fits that theme. It's relatively inexpensive. It should be a later cycle play as the economy continues to recover, and good dividend yield.
And so you are betting though that there's going to be some decent economic growth.
I think there's no question that the market's going to grow. Probably the GDP is going to be 3 to 4%. It's just that the market in its run up.
It's already priced this in, right?
Anticipated that, so it's going to have to be better than that. We're calling for 3 to 4% GDP growth, which in the context of the recession that we had is actually quite muted recovery. People look at that as a big recovery, but on average, we should be having 8 to 10% GDP growth.
Right, it's not a V, it's like a little check
exactly.
mark. You know?
Based on the downturn we have, we should be having much stronger growth. So we think that's a very reasonable scenario to think about.
What happens if the Fed raises rates, let's say, between now and the November midterm elections? Do you go back and change a lot of the allocations?
No, I think that's what we think is going to happen.
Yeah.
We think the Fed is going to take the extended period language out in the first half of the year, and then within 3 to 6 months of doing that, they're going to start to raise rates, which puts you in the second half of the year. As you get closer to the election, it gets trickier, as you know. So.
Right, because then you can't do it because the politics starts to take over.
And the Fed's probably already compromised from that standpoint. But
all right, I want to thank you very much. Yeah. Walter Todd coming in, Co-Chief Investment Officer, Greenwood Capital.